Good afternoon, everyone. This is Bob Haberkorn, Senior Market Strategist at RJO Futures, here today to discuss hedging, specifically hedging stocks. Since 2008, we've seen significant upside in the equity markets, in particular with the S&P, with the Dow, and with particular stocks. The chart I'm showing to you right now doesn't go back to 2008, but it shows you the upside trajectory that we've seen in equities. Specifically here, starting back on November 12, 2013, you can see when the S&P was trading at 1365. Now that wasn't that long ago. Since then, we've seen the market trade as high back here on May 22nd of this year to 2131. Well, there's been zero volatility in that with that move that we've seen over the last 2-3 years, but investors are a little worried right now. We're finally starting to enter into a time that we haven't seen in some time, and that is the Fed actually talking about raising interest rates. December 16th, we'll know more about that, whether they do a quarter point and do start liftoff, but that is yet to be determined. But with the advent of that, you are starting to see some more volatility come into this market, and investors are concerned. They have a lot of people have substantial gains in 401ks and stock accounts, and they're looking for ways to protect their gains without liquidating and moving to cash. Common strategy that we always recommend to clients here and recommend to prospects is hedging via S&P, mini S&P options. You can see here, if you go back, this is a more recent chart that will show you some of the volatility that we are starting to see again here. Now, if you go back here, I mean, with the chart that I'm showing you right now is basically from here on, and you do see some moves. We're currently today, the S&Ps are trading down at 2023. That's after having a significant downside move yesterday. S&Ps traded as high as 2077 yesterday and ended up closing out at 2040, almost on their lows. And we have more downside here today. So currently, with the renewed volatility that we're seeing in the market with the anticipation of a Fed rate increase on December 16th, this is a recent chart here. It goes back. You can see the volatility that we're seeing as of recently. August 18th. This was leading into the September meeting when traders anticipated that the Fed was going to raise rates at the September meeting. They didn't, but this was the sell-off that we saw, and then the comeback here after they did not raise rates. You're starting to see it again because the talk is that the Fed is going to do a quarter point increase. Will a quarter point change the world? No, but it is the perception that the U.S. Fed is raising rates while other central banks are cutting, specifically China and Europe at this point. But you got to look for protection and protect yourself in these times. And like I said, options are one way to do it. While you're not going to get an apple-to-an-apple hedge with options, they will give you a sense of protection and where you can sleep at night and actually not worry about market washouts to an extent. And one common strategy that we would recommend here, because the Fed is December 16th, is to maybe look at, like, for instance, the December 1950 puts on the mini S&P. The value per tick in the S&P is $50. So currently we're trading at 2019. If the market goes down to 2018, that's $50. If it goes up to 2020, that's $50. 5-point move would be the equivalent to $250. That'll help you gauge a little bit of where and how much you want to hedge. And the way options work, if you're not familiar with options, is intrinsic and time. Intrinsic being what's the value of the asset, and time being how much time is left. The December options will get you through past 2 days after the Fed meeting. If you'd like your hedge to go out even further, you will pay more because with time, there is a value. Time is valued with options. But I don't want to get too specific with the exact strikes I would look at because the market will change. I mean, we're selling off as I'm talking right now here, making new lows here down to 2019. But if you'd like to get something more specific, I would recommend you call us and discuss with one of us how this type of strategy would work. We can go through what type of equity you have, what you're looking to protect, and go from there. Back in 08, 09, this has been a very common strategy used by investors through some volatile times to protect what they already have. And like I said, give us a call here. We'd be more than happy to walk you through any strategy and go over specifically how the hedge would work for your portfolio. Don't hesitate to hedge. Remember, we're going into the year here, the Fed, and anticipate more volatility. Take care.